digital asset world is full of experimentation. Some ideas succeed and become the next big thing, but many do not. How do we tell what ideas might or might not work? It isn't easy. Today, on Crypto Clarified, we're going to look at some of the new and cutting-edge ideas currently being developed in the digital asset ecosystem. My name is Benjamin Dean. I'm a director in WisdomTree's digital asset team. Welcome back. In this podcast, we examine the complex and fast-moving crypto space so you can navigate its various opportunities and risks. To help me with the episode today, I'm joined by David Duong, who's the head of institutional research at Coinbase. Before we start, US listeners, check out wisdomtreeprime.com in the Apple or Android app stores. Hit subscribe and share on Spotify, YouTube, or iTunes, and you can check me out on the Bird app at Benjamin Dean. Before we kick off, Jams, Sam, in compliance, listeners, they've told me you have to listen to the disclaimer because otherwise unspeakable things will happen to me, so please listen. Before I begin, I need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and Coinbase and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities and reliance upon them. It's at the sole discretion of the listener. Please remember, past performance is no indication of future results. Now we're going to move on to the fun stuff with David Duong. David Duong, head of institutional research at Coinbase. David, welcome back. It's nice to see you again.
Thanks a lot. Thanks for having me, Ben.
So today's discussion, we're going to have kind of a grab bag of different topics, but I think for the listeners, it will be interesting just to hear about how much is going on in this digital asset space, some of the more experimental things that you and I get to keep our eyes on, and some of the non-obvious things out there because it is a complex and fast-moving space. Before we kick things off, though, why don't you just give the listeners a feel for kind of your background and what you do at Coinbase?
Yeah, thanks. So actually, my background's in computer science, but I've spent the last 17 to 20 years actually covering macroeconomics. And prior to joining Coinbase, which is about 2 years ago, I was actually in TradFi. I was actually covering emerging markets, rates, and FX. And I was previously the head of Latin America at HSBC.
Very nice. Well, we're going to have tons to talk about then because we share a couple of pieces in common. Let's kick things off topic-wise. Talking about layer twos. Now, in the show, in previous episodes, we've spoken with people about layer twos for Ethereum. So we don't have to go into too much detail about what they are, but it is a space that if you and I were talking 18 months ago, we probably wouldn't have covered it. It is a space that's now grown and diversified. How about you give folks kind of your snapshot about the layer two space, where it's at, and what's interesting to you?
Yeah, I like that L2s or layer 2s started out as an experiment for Ethereum as one way to scale it, because prior to this, the roadmap for Ethereum really depended on sharding and trying to grow the network that way. But layer 2s have kind of worked out so well that it's become part of the Ethereum roadmap. And we have the Cancun fork, or the Cancun fork, as some people call it, that's coming up very likely at the end of this month, if not early March. And that's going to further expand that by putting more space on the blockchain specifically for L2s. So I think that's going to, of course, reduce the fees. It's going to improve things, increase the throughput. What's been really interesting is the experimentation for me that's really happened with layer twos. So it's not just relegated to the idea of like, hey, how do we park more things on things outside the Ethereum mainnet? It really has become, well, what else can we do? Can we put other virtual machines that run on these layer twos, for example? Can we include ZK proofs on these things? Like what do we do to just kind of not just expand it, but really improve upon the current infrastructure?
There's that word, zero knowledge proofs. That's super interesting. There's this kind of distinction between two kinds of doing these roll-ups, these layer twos. One's the optimistic stack and the other's the zero knowledge proofs. Do you have any kind of strong views about which stack is the one that you think might prevail, if any? They are complicated at a technical level, but what is interesting is that you've got these two ways of solving the scalability problem. Some of them have tokens attached to them, others do not. What do you think is going on there in that horse race between the two kind of wider standards that are competing at the moment for market share?
Yeah, I would say optimistic rollups had a very strong advantage. And I think initially, we were very clear about the trade-offs between what would happen with a zero knowledge layer two versus an optimistic layer two. And one of that was actually being able to get your assets from off chain from like the L2 itself. And the costs that you would pay for the optimistic rollups tend to be, well, I would maybe have to be unable to get access to those tokens for up to a week until we were sure that no one objected to the final state of things. It doesn't seem, however, that that became a real issue. And in fact, most people were just kind of keeping their assets on the L2 anyway and transacting and remaining completely on chain. So I think some of that concern kind of fell by the wayside. And it became much more important to just have a performant L2 that was cheap and that you can transact on. And it didn't necessarily become as big a concern to get right away to zero knowledge proofs where you wouldn't necessarily have that same trade-off, but there was, perhaps more expensive transactions that you might have to have on the ZK because you have to pay for it somewhere. So I think that this is what we've seen. There is a third option too, which is zero knowledge EVMs or ZK EVMs as well, where the real benefit of that is that you would not only have EVM equivalents, so a lot of these applications that are running in Ethereum could actually just natively port themselves over to a ZK EVM without having to do a lot of translation. They call it like the transpiler itself would actually allow that to happen very easily. But you would probably capture some of the best of both worlds in a lot of ways. But we haven't necessarily seen like one of those ZK EVMs emerge as a clear winner, and they do exist right now. They're operating on Ethereum, but really it's been optimistic rollups game to lose in the last probably year or so.
Just to step back a little bit for the listeners' sake here, because you and I follow this so closely, and there's lots of jargon and acronyms and things like that. Maybe the closest historical parallel that comes to mind is either GSM CDMA for cell phones or it's Betamax VHS for home movies. Like you have these competing standards, they have their pros and cons. They're trying to solve a problem. And then the one that's ultimately, here's the irony, or maybe it's just the quirk of history. The ones that win in inverted commas aren't always the best on all dimensions, are they? Like Betamax was better than VHS, but VHS just ended up everywhere and won by default. I understand that it's a space in flux at the moment. We've got, maybe you've mentioned 3 competing standards. How are they going? And when I say that, I mean, you've got the Ethereum base layer, and a running thesis some people have had is that, well, if the transactions move up the stack, these layer twos, whichever captures all of those transactions and fees becomes the winner ultimately. Where does that sit at the moment? And are they actually eating market share off that base layer, which comes with its own transaction fees?
Yeah, that's a really good question. And I like your analogy in terms of, just because you have the best technology doesn't necessarily mean that you're going to become more well used by most players, and I think the Betamax versus VHS example is a good one because it's not that having the superior technology itself was the be all end all of it. A lot of it had to do with making that technology accessible. And that's what really happened with VHS. And that's why people used it. Um, and I'm not trying to, cast shade on any of these technologies because, like I said, they all have their own like strengths and weaknesses. I don't think like any of them by itself or, I could consider like quote unquote the more superior technology per se. But I think that what we are seeing right now, and holistically, there was this concern, and I definitely expressed this. I expressed this back in like middle of 2022, for example, that you would see a lot of the L2s potentially eat Ethereum's lunch because could the activity that you see migrating to layer twos be dilutive to the actual activity that we see on the mainnet proper? So far, we haven't seen that. Like we've seen that a lot of the total value bridged over from into the L2s, I should say, actually didn't come from Ethereum, but really came from other EVM chains. So
Mhm.
what we've seen, at least in the first phase of things, is that a lot of the layer twos have been capturing activity away from some of the other EVM L1s out there that are not Ethereum itself. That said, we have seen that in terms of the amount of ETH burned in terms of activity, and hopefully people are aware of like EIP 1559, for example, that allows like Ethereum, the ETH itself, to be burned, like depending on the level of activity, like the base fee. We've seen that actually L2s went from representing around 3% of that to around 9% to 10% of that. So we have seen a pretty big increase. That said, a lot of what is being burned as far as ETH in terms of the fees themselves are generated by activity that happens on mainnet, about 90% of that. So, we haven't yet seen that L2s are really kind of taking a bigger share of that and or like reducing the activity so far as like it actually hurts Ethereum itself. If anything, we still believe that our view of if you can grow the pie and if L2s bring on more activity, Ethereum actually benefits in the end.
Okay. So for all of those institutional investor listeners out there who ask me sometimes, so what? It's very nice to talk about technology, but so what? Well, what Dave and I are basically analyzing here is the investment case for Ethereum. Are transactions going to process through that network? And then do people need Ether to do it? And if so, that's demand for Ether. Dave has just pointed out that activities migrating from other layer ones like Solana, potentially, and others. So that changed the investment case for those other alternatives. And then there's a question of if any of these layer twos break out as the winner take all, some of them have tokens attached to them, which would influence the investor case for them as well. So that's the so what on that one. It is an evolving space. It is rather interesting to watch play out. But let's turn to the next topic because we've got so much to talk about, David. There's so much to talk about, and we don't have enough time. I'm interested in your thoughts about gaming. Now, the gaming industry is bigger than US sports and Hollywood combined in terms of annual revenues. It's a massive industry. Right. And for years, a few years, people have been pointing at this kind of intersection between this digital asset, crypto infrastructure, and this kind of virtual world gaming thing. I haven't kept a very close eye on it recently. So I'd look to you to give us kind of a panorama of if anything is happening at that intersection still, and if so, what you think is kind of an interesting thing to look at.
Yeah, hopefully most people are already aware of what a big opportunity gaming represents, and if you don't, the numbers are like currently there's a total addressable market for the gaming industry of around $250 billion. This is, not including like Web3. This is just the whole gaming industry. But that is projected to grow to $390 billion over the next 5 years. So this is a big opportunity. Previously, what we've seen is that there have been existing examples in the Web3 space, in the crypto space, of how gaming and crypto actually intersects. A really early project here was Axie Infinity. And this was a model that initially brought up the whole play to earn kind of framework for how to incorporate gaming into crypto. I think fortunately or unfortunately, like it wasn't necessarily very sticky because at least there was a lot of skepticism coming from mainstream gamers of like, oh man, like of course, like, like to be honest with you, and there wasn't much to do in Axie Infinity. I'll be honest. It just, for me at least, it wasn't a very fun game, but it did show that there was a way to monetize it and put it into crypto. I think right now there's still skepticism around that idea. So whatever next iteration of games are going to appear for Web3, I don't think it's going to be the play to earn model. It probably will be something else. And we've seen a lot of passive games kind of emerge over the last few years, but no big what would be called a AAA high quality game has necessarily materialized. It takes generally around like 2 to 3 years to come up with a high quality AAA game like that. The good thing about this is that a lot of the investments, because of Axie Infinity, a lot of that money flowed through sometime like 2021, 2022. That's when a lot of the fundraising would be done. well, hey, that happens to be like 2 to 3 years after this is the future now, where we are expecting like what one of those Web3 games might look like. So looking into this year, we're expecting some of those names to probably appear. Whoever that's going to be, though, I think that's really hard to tell. And so some of the ways people have looked to invest in the gaming sector has been through platforms that already include gaming in some way, like Immutable X, things like that, where they're trying to host that potential game.
It is. I've got to collect my thoughts here. I like that point there. Yes, you've got that first generation that comes through. Most of them didn't work. That doesn't mean that it's necessarily like it's going to disappear. I'm reminded of Atari. If you had said in the late 80s when they had the big video game boom and bust, and Atari was the one that was taken down because they licensed too many bad games, and then you sat there and said, well, that's it for gaming. Well, you would have missed one of the biggest industries in the last 20, 30 years. It's got a nice story around taking it from a niche hobbyist crowd all the way through to mass adoption. You can see people pecking away on their cell phones on games on their cell phones now. It's not just a niche thing. I'd feel remiss if I didn't keep at least one eye on it, because if someone does kind of crack that nut and work out something that is sustainable, fun, useful in the sense it's entertainment, then something might come out of it. It hasn't yet. How's the fundraising scene for it at the moment? I mean, we know venture capital's gone down for the space broadly, but are any of these things being funded anymore, or are we just waiting for Electronic Arts to go there and throw some money behind it?
It's still being funded, and we've seen headlines like that. Actually, you pointed out a big one. Like, there's actually a lot of names out there, like both from the mobile gaming scene as well as from the like traditional gaming scene. I guess I don't know what they would call it traditional, but
Trad gaming.
trad gaming, I guess is the term. Like, this is actually a pet peeve of mine because we call it GameFi and sometimes, and I'm like, it's not decentralized finance where it's like DeFi. It's not gaming finance. Although I get why they say that, because you're trying to introduce elements of like monetization, but that's gaming all around, right? No one builds this stuff for free, even in the regular gaming sector. But yeah, you are seeing a lot of that still kind of come through. But I think that in terms of the launches that we're expecting for this year, a lot of that tends to be pre-existing VC money.
I wonder if the actual angle on this is not so much, putting these tokens into games, but it's just using the tokens as a fundraising mechanism. Like, independent gaming is really hard, actually. And you get this kind of power law dynamic where Candy Crush goes nuts and like 1,000 other games fail. Like, maybe that is actually, at the end of the day, the thing that's useful, using the technology to fundraise for indie games. Maybe if they can reconcile it with securities law and whatnot, you can actually unlock some capital out there, because it's we know from ICOs the technology works. We know that they don't have equity rights attached to them, but they could. I mean, it's just off the top of my head, but I'll be interested to see how that evolves over time. Let's move on. Acronym time. DPIN and DComp. Now, a few weeks ago when I saw you and you... So, listener background, Dave and I were in Zurich the other week and we're doing a talk. And David looked at me and said, Ben, what do you think about DPIN? I was like, David, I don't know what DPIN is. so this time,
you covered it well. Yeah.
Instead of you asking me the question I don't know the answer to, I'm going to ask you the questions which I know you have the answer to. Run the listeners through the two acronyms, DPIN and DComp. You might have to give them some background on like what they are, but why they've come about. Because that, from what you described the other week, is mildly interesting to me. And if it's mildly interesting to me, it's probably very interesting to other people.
So I would preface this with two things. Like, number one is that we think a lot about how does crypto intersect with the real world, right? One of the big themes that people talk about with that is tokenization. And it's a major theme in terms of trying to like take, property or art, which is harder, but more likely treasuries and other securities, and tokenize it and put it on chain. But I think another way we're thinking about how the real world intersects with that with crypto and blockchain technology is DPIN. And that kind of brings me to the second point, because oftentimes when we think about crypto, we think about Web3 and how that's going to change the internet, or Web 2.0, as far as a lot of Web 2 analogs that already exist. What I mean by that is oftentimes we're kind of iterating on things that are already are there. Social media, for example. How do we change that, make it uniquely crypto, and kind of put it on a blockchain, for example? And we are seeing some of that happen today. Like Farcaster is a really good example of that, where it's kind of like a Twitter. But what you're doing with that instead is saying, like, let's introduce new things that you couldn't do with Twitter. Let's put frames on there so that people can play games, for example, or kind of put a web page like kind of user interface inside of a social media network. So gaming is another example of that. Payments, which I'm sure like people are very familiar with. These are all what I would consider like Web 2 analogs, and making them better in some way, shape, or form. That's great. DPIN, however, and decomp, or decentralized compute, I think are ways of actually being very uniquely crypto from the ground up. So with that, I'm going to introduce DPIN, which stands for Decentralized Physical Infrastructure Networks. And that's a very long phrase, which is why we've shortened it down to like DPIN. But what it really means is incentivizing the supply and demand dynamics that allow us to build physical infrastructure. And that physical infrastructure can be anything. It could be telecommunications networks. It could be data storage. It could be mapping. An example I brought up with Ben in Zurich is there's something called Hive Mapper out there. And what they kind of do is incentivize people to put mobility sensors on their cars. So you're probably already familiar with Google Maps or some sort of mapping service that you have on your phone right now. The way they did it was, Google sent a bunch of cars out onto the road, and they had cameras and they just recorded everything. So why not do that in a decentralized way? And you might say, well, why do it a decentralized way? Because the reason is a centralized entity like Google isn't necessarily going to go out there to like all the streets that have like bad lighting and isn't a major epicenter where people live, or isn't a major city where people want to live. So there are just places out there that have just gone unmapped. Well, what if you just incentivize people to say, like, you know what, take the sensor, put it in your car, drive around, and earn some tokens while you're at it? Like, that is the idea behind Hive Mapper, and they've built enough of a platform right now that you can actually start, earning money also by using this map. So I think that what we've seen historically is that a lot of this was people kind of thinking like, well, let's create the supply for this stuff. Now, I think what we saw in 2023 was a transition away from saying just the supply side of the equation to saying, like, how do we incentivize people to actually use this stuff? Because we've got a good product. We want people to use it now. Like, let's build that out. And that's where decentralized, or DPIN rather, kind of comes from. Having decentralized solutions to like kind of the real world things that we've seen kind of exist, and interacting with the real world in some way to incentivize people to build and use this stuff.
All right, before we go to decomp, I have two questions. One of them is, well, so what decentralized? So why does it have to be decentralized? Why is that a good thing? Was that better than like a better mousetrap? I don't know, so I ask. The second has to do with where does the money come from, right? So yeah, you can create tokens and you can put them out there and you can hand them to people for doing stuff, but does that mean the token has a non-zero value? I don't know. And then, who is paying whom to do what, and where are they getting the money? And they're two broad questions, but they come straight to mind. And I look to you for some even partial answers, because it's happening. I just don't I haven't got my head fully wrapped around it.
So I will say that I'm not an apologist for all of the technology that's out there. I don't necessarily think, for example, everything in the world needs to be decentralized. Like, personally, I think that there are certain things where if there's enough trust out there, like, I have a friend who works in supply logistics, for example, and I talked to him about this topic of like, well, like, I asked him directly, do we need supply chains to be like on the blockchain, for example? Because in my mind, it would make a lot of sense, like buyers, sellers connected. We know like what the path is from like origin to like destination of like all the stuff. And he told me, no, because I trust a lot of like the vendors I use. Like we just can have like a central like database, and we all can rely upon it, and it's fine. And I didn't realize that. Like I in my mind I was like, no, clearly this is a place for blockchain to innovate. And in his view, he's like, not really, because the whole point of having things on a blockchain is the trustlessness of that. And if you already trust the counterparties you're with, I think there will be a point in time if onboarding new counterparties and things like that. But when it comes to things like DePIN, a lot of it tends to be how much resilience do we need in these networks? How much resilience do we need, say, like if we have, let's just take a very simple example of like Web3. Right now we rely, or I'm sorry, the internet as we use things. Right now we rely a lot on our actual like service providers, right? So if I'm actually doing this, I use Verizon Fios, for example. Like I require Verizon Fios to kind of provide me like, and I interact with that. My internet service provider, my ISP, is integral to that. But there's a lot that could be either blocked or like infrastructure that can kind of go down. And we've seen that in the world, for example, you have countries that put up firewalls that don't allow you to get certain content from certain parts of the world. What if there was a decentralized way where that information couldn't be blocked because it's decentralized and it couldn't be centrally disturbed by any large entities? Would that be of value? I think it would be, for example. That's kind of what the DePIN movement represents. Like how much resilience and how much like tolerance do we have for these entities or these networks being blocked by some centralized company, some centralized entity in some way? If you believe that there should be, and you believe access shouldn't be blocked, then you should believe that DePIN has value. That's kind of where I come from.
Okay. I can see a situation. Well, I take your point on resiliency. That is something that from a distributed network you get. There's no single point of failure, no central choke point. I'm not sure how that maps onto all the DePIN stuff, but I can see kind of where you end up with these kind of common goods almost. Some people might call them public goods, where nobody really owns it. It exists. It's a way to coordinate people and their resources without a central authority. And maybe you can come up with something that's better on certain dimensions than that which exists now. It's I can see it happening out there, and I see people experimenting. It's just not fully clear to me the business model over time. I might be missing something,
I
but
mean, that
hey,
was just one example in terms of resiliency. There's
yep.
also ways where like they've used like okay, so a pretty big project that kind of I wouldn't say kickstarted, but definitely one of the early projects in DePIN was Helium, for example.
Mm-hmm.
And they've iterated now through their business model. So it's a little bit different from when it started. But when it started, what it was trying to do was actually take advantage of all the like network. There's, people are familiar with networks and that we operate on a spectrum, for example, and there are certain bands that are just free and don't get used because they're not used for anything. The early way Helium was kind of created was that they wanted to take advantage of those bands that weren't being used in order to promote the Internet of Things. Remember when we wanted to like have everything like connected like on in some sort of network,
The
but you didn't want to
refrigerator.
connect it. Which, by the way, it turned out wasn't the best thing to have my microwave connected to my internet. But regardless, that was one of the prospects that they had of like, well, how do we build out the Internet of Things? Well, what if we incentivize people to put little routers on like in their homes or in different places, for example, to spread out that network so the latency wouldn't be as high and you could actually connect all of these things. So, I mean, there were some very unique initial cases. Now, like I said, Helium has since expanded it beyond that, and they connected themselves to a 5G network, et cetera. But there are also very unique ways that DePIN is being utilized to actually materialize those kind of use cases.
Yeah, I've heard about distributed grids for a while. Power Ledger, I think they were called a few years ago. Coincidentally enough, a bunch of Australians. Um, the core idea was there. They couldn't commercialize it, but to bring it back to listeners, if you're looking at cutting edge emerging technology and you can't do venture capital or angel investment, but you think there might be something there that's potentially disruptive in the future, well, here you go. Here's the opportunity. Here's where you start weighting it. Lots of experimentation. I could see the utility from a common goods perspective and for providing things that just wouldn't exist because they can't be funded. But let's move on to the last one. because it's another one that I don't know about, but you do. It's a good thing we have you on the podcast today, David. Restaking. Now, the listeners know about staking in context of Ethereum. There's this term that I saw it in your annual report, and listeners, go check out David's 2024 Outlook report at Coinbase because it's very good. You mentioned restaking, and then you and I have talked before about something called EigenLayer.
That's right.
Very new stuff. I don't fully get it, but I need your help.
Okay.
What is
All right.
restaking? Why are people doing it? Why do they think that's something that deserves time and energy and resources? And then what is EigenLayer, and how does it kind of all fit together?
Yeah, I think this is going to be a big one, especially in 2024. But then that said, I did say the same thing in 2023, and we were still kind of on the path. I think that like we'll finally see it kind of materialize, though, in terms of the actual benefits to Ethereum and in Ether holders themselves. Now that said, of course, like oftentimes you would, in order to get the full benefits of restaking, because the idea is that I get paid for actually using the stake I have as a validator to secure other things. So the yield, technically, I will only accrue it if I actually, if I actually opt in to restaking. But I think that there's a benefit to broader holders as well. But anyway, let me kind of start from the beginning because I went on a whole tangent before I got to the point. But restaking is effectively what I would call security as a service. So right now on Ethereum, if you're a validator, for example, what do you sell as a layer one? You're selling block space. That's the idea. That's your main source of revenue, right? Like people want to put things on the network. They want to put things on chain, as we say in crypto parlance, and we are selling that. But we don't really diversify away from that business model. Restaking is one way that we as validators, I should say, validators being the ones who actually secure the network through their activities, can actually have another source of revenue. So not only am I selling the block space, but now I am actually also selling the security itself. I do that by saying that the 32 ETH that I use to kind of that I put in basically as collateral in order to kind of opt in to be a validator to secure the network, I can use that to actually secure other things. And what are those other things? Those things could be data availability layers. They could be bridges. They could, in fact, be other networks entirely, which is something that was kind of outside of scope in the initial kind of imaginings of EigenLayer, and now is definitely well within it. So you can actually delegate that staked position to what we would call actively validated services. So these other things, these middleware layers, these potentially even applications or other networks, and actually say like, I will secure that so that instead of you having to do it yourself and like having to actually come up with like a whole validator network in order to support it, I'll do it, and you'll pay me for that service. So you pay me using the 32 ETH I already have to secure the network. So if you're an ETH validator, an Ethereum validator, not only am I getting the base fee, as well as like the tips rather that come from the transactions themselves. So not the base fee that gets burned. Excuse me, misspoke. But not only do you get paid from the transactions themselves, but also I might get paid, let's say, something from MEV. I might also get paid something from restaking. My yield can actually increase very quickly from the base yield that we get today of like 3.5%, 4%, to upwards of multiples of that. So I think that is the real value that kind of comes from EigenLayer. And not only does the validator then get paid, but also we are potentially securing things that would be otherwise fairly onerous to actually incorporate into Ethereum itself.
All right. So you don't have to go and bootstrap your own new network in essence. You use the existing network. And what are validators? The computers. And you tell the computers, well, you keep validating the Ethereum network, but we're going to use this critical mass, and you're going to start computers, you're going and you're doing other work, which involves securing other networks by leveraging the pre-existing infrastructure that's sprouted up for Ethereum. Is that? close?
It's it. That's absolutely right. But I will make a point that you do have to understand two things. Number one, this is not without its risks because, of
Okay.
course, as a validator, you have something called slashing. And if you do not perform your duties as a validator, you get slashed, which means if you're down for too long a period of time, and some people ask me like, well, does that mean that if I go on vacation, I'm going to get slashed? It's like, not necessarily. And if it does happen, it's going to be very, very minor. Your
Hmm.
slashing risk
Yeah.
as a validator today is, to be fair, fairly limited, even if you're running your own node. But potentially your slashing risk as a restaking, when you opt into restaking, could be much higher. And that kind of brings me to the second point. It's not without this isn't completely low risk because as a validator, like you kind of just like learn how to run the software, and for the most part, you're fine. But like you might be asked to do something more in order to secure an AVS, and I don't. It will differ by AVS, by which service you opt into and choose to kind of support. But it's all incumbent on you to learn how to do that. So it's not without like there is a learning curve that has to be like done in order to actually take advantage of EigenLayer.
Okay. Okay. Um, so for listeners, if you think the Ethereum network is going to end up becoming almost a base layer for a set of distributed systems, the uses of which are being invented or haven't been invented yet, you buy Ether and you stake it. And then, as David says, you can do this restaking to be rewarded for telling your computers to do more work. But if you think that the Ethereum network is going to become this base layer for all kinds of other things out there, then that's it builds up basically the ecosystem for Ethereum network, the stability and the security of the network. It starts to fade into the background a little bit, and it just becomes like digital infrastructure that sits in the back of the scenes, but is resilient and strong enough to survive. Um, Thank you for that explanation. I know it's a complicated topic, but it's definitely one to keep an eye on because if somebody works out a way to leverage that Ethereum network and the power of it for other purposes, then that can create other opportunities down the line. But I also appreciate you pointing out the risks because there's always trade-offs involved as these things evolve over time.
There's no
We are
free
coming up on
lunch.
time, though. I know that we could speak for hours, but we've only got so much time. We've just spent the last half an hour talking about the future, which I love doing. So we're not going to close this episode by asking you to tell us about the future because we've just done it. Uh, Outside of the topics we've just run through and from where you sit in your role at Coinbase, is there any one last thing that you find interesting that we haven't covered that the listeners might also find interesting?
So I think that a big theme is still going to be the intersection of AI and crypto. And, like in part, that kind of brings us back to the DePIN movement or
Okay.
decentralized compute movement. I mean, these are not unrelated topics. I still
Hmm.
think it's very hard to express AI within the blockchain, but we are
Yeah.
seeing projects that are coming up and that are doing so. I think it's going to be interesting because I think the future of AI itself is probably going to be more of people actually training the models on our personal data. So as right now we're training it on like the internet and all this other stuff. But I think we're going to start seeing the AI. We're going to make it more in tune with our personal needs. And I think having like privacy enablement through blockchain technology is one way we're going to see that. So I think that's going to be a very big theme as well into the future.
Okay. Yeah, it's a bit of a buzzword thing, isn't it? But if you kind of break down, we're talking about open source software, so there's that commonality. We're watching people fight it out right now for the copyright over the training sets, essentially. Um, I could see a world in which you use these networks, distributed networks, to recompense people for data. Um, it's maybe you don't store the data on a blockchain and you don't do the computations on a blockchain. That's separate. But I can see a world in which, going back to the idea of common goods, knowledge is a public good. Um, and if you start unpicking that and thinking about incentive systems and using this distributed technology as a way to incentivize certain behavior, I could see a world in which there's kind of niche cases there for something that's not training data controlled by massive conglomerates. and is something that does emerge as being a more public good than what you see from like OpenAI, for instance. That's kind of interesting. Thank you for that.
Yeah.
That's been a great discussion. I know we could keep going longer and longer and longer, but I'm sure in the future we'll have many other opportunities to do so, because there's never a shortage of new things to talk about in this space. With that, David, I thank you once again, and I look forward to seeing you again very soon.
Yeah, thanks for having me, Ben.
And there you have it, folks. David Duong, Head of Institutional Research at Coinbase, for a very long and stimulating discussion about cutting-edge trends in the digital asset space. US listeners, wisdomtreeprime.com. Check it out, Apple or Android app stores. Check me out at Benjamin Dean on the Bird app. Thank you again for listening, and I'm looking forward to seeing you again next time.